Here's something that will change how you think about money. 85% of professional money managers fail to beat index funds over a 15-year period. Let me repeat that. People whose entire job is picking winning stocks, who study markets full-time, who have million-dollar research teams, they lose to a machine that does literally nothing. This isn't pessimism, it's math. And if professionals can't beat passive index investing, what does that tell you about trying to do it yourself? An index fund is genuinely simple once you understand it. Imagine you want to own a piece of every major company in the stock market. Apple, Microsoft, Amazon, all 500 of them. Buying each stock individually would cost thousands and take hours. An index fund lets you buy one thing that automatically owns a little piece of all the companies. The S&P 500 Index Fund, for example, gives you ownership in the largest U.S. companies with a single purchase. That's it. You're not picking winners or losers. You're just buying the entire game. Let's talk about why this actually works mathematically. Between 1990 and 2020, the S&P 500 returned an average of 10% per year. Sounds small? If you invested $5,000 at age 20, never added another dollar, and let it sit until 60, you'd have $1.2 million, not because you're a genius, because time and compound interest did the work for you. Most active traders need 15% annual returns just to beat that, and they don't get them. They get stress, fees, and tax bills instead. Starting is embarrassingly straightforward. Step 1. Open a brokerage account. Vanguard, Fidelity, or Charles Schwab all take 5 minutes online. Step 2. Fund it with whatever you can. Even $50 is enough. Step 3. Buy a low-cost index fund. Usually something like VOO or VTI if you're in the US. That's the whole system. No stock picking, no watching CNBC, no day trading at midnight. You're done. The account does the work while you sleep. Here's what kills most beginners. They wait for the perfect time to invest. They're waiting for a market crash that might not come for years. Meanwhile, someone who invested on the worst possible day in 2008, right before the market dropped 50%, would still have tripled their money by today if they just left it alone. Time beats timing. Every single time. Your first dollar invested at 20 matters more than your 1,000th dollar invested at 40. The fees are the hidden killer nobody talks about. If you're paying 1% per year in fees to an active manager, that seems small until you calculate it over 40 years. That 1% fee compounds too, and it works against you. It costs you roughly 30% of your final wealth. Index funds charge 0.03% to 0.20%. You're paying almost nothing. The difference between a 1% fee and a 0.1% fee is literally hundreds of thousands of dollars over a lifetime. It's not glamorous, but it's real. You need to understand one more thing. Diversification isn't just a word, it's insurance. If you own one stock and that company collapses, you lose everything. If you own 500 companies through an index fund and one collapses, it barely registers because you own such a tiny piece. You sleep better. Your money grows steadier. Your psychology stays intact through market chaos. That's worth more than the perfect stock pick. Here's what you do next. Open an account this week, not next month. Put whatever money you can afford to not touch into one index fund. Set it to auto-invest another small amount every month if possible. Even $100 counts. Then forget about it. Don't check it daily. Don't panic when it drops 10%. Don't get greedy when it rises 20%. You're playing a 40-year game, not a 40-minute one. The people who get rich investing aren't smarter than you. They just started earlier and changed nothing. So start today. Like and subscribe for more personal finance strategies that actually move the needle.